Welcome to Investors Insights. Our topic today, elections, rates, and stocks. We're going to elaborate on that topic here as we go through this blog. And I'm joined by my distinguished colleagues and have had a great meeting with them, Bobby Norman, Trey Booth, and Ty Miller. All of us are on the Portfolio Strategies team here at Five Plan Partners. Before we get into our discussion, though, just as a firm, we want to thank those veterans who have served our country. We want to thank veterans and their families, all who sacrificed, took time out of their lives to see to it that we had freedom throughout not only our country, but around the world. And for that, we're very thankful. We're very appreciative. We do not forget, and we thank you for your service. And know that each and every day here at Five Plan Partners, we remember your commitment and your determination to help others and to see to it that freedom and democracy is throughout the globe. With that said, we now have got some historic times going on, and we're going to talk about elections, rates, and stocks. I'm going to ask Bobby Norman to start us off, because if you go back to our previous vlogs, we've worked up to the election, looking at data, economy, historical data as well in relation to economy and markets. And so what we want to do today, the election now is behind us. Bobby, talk about that in relation to the markets and corporate earnings.
Yeah, so for months, we have been talking with clients about the impact of elections. And a lot of the questions we have received back are, which party is best for the markets? So I want to share this chart that shows performance of the S&P 500 going back to the 1980s under each administration. You can see that U.S. companies have a history of skillfully managing their way through different political climates, resulting in strong returns under both Republican and Democrat administrations. So with the election over, markets can refocus their attention on economic numbers and corporate earnings. And post-election, the U.S. economy is in strong shape, with consumer and government spending propelling GDP at a 2.8% annual rate. Inflation is trending down. Wage growth remains manageable. And important point that happened last week, the Federal Reserve remains in the early stages of rate cuts. So despite some unusual patterns playing out in the post-COVID business cycle, we aren't seeing the kind of buildup of excess that we typically see before a significant recession. So that obviously favors risk assets like stocks. So the point is, don't let politics derail your long-term investment strategy. Your long-term investment strategy and performance is impacted greater by economic strength and corporate earnings than it is by politics.
Well said, Bobby, and thank you for those comments and that insight. And complementing that, Trey, you talked about this past week, we saw the Fed cut rates. And in our last vlog, folks, if you go back, you can track us. We try to line things up to let you know what we're looking at. But in last week, we talked about how important the Fed meeting was. This week, even though the election was taking place, the Fed meeting was really important. Now we have another quarter rate cut, 25 bips. Talk about that.
Yeah, thanks, Rick. So yeah, as we talked about in our previous vlog, the Fed seems to be having the opposite effect on the bond market. When you hear about the Fed cutting rates, most people think, okay, interest rates are going to go down. The Fed doesn't control all interest rates. They just control the federal funds rate. And so what's concerning to us and what we're watching closely is the Fed cut rates 50 basis points back in September. And since then, the 10-year Treasury, as we talked about last week, has moved up from below 3.7 to 4.2. And then now the 10-year Treasury sits at around 4.3, 4.4%. The Fed cut rates another 25 basis points. Will that continue to have the opposite effect on long-term rates? Will 10-year Treasuries go? Because it starts getting concerning at these levels. You can see on this chart, the S&P 500 has dropped, has gone on a downward cycle every time the 10-year Treasury has crossed 4.5%. You see those last three times. And so we're starting to get close to that level where the markets start pricing that in. Now, why is that? Why is 4.5% a concern? And the next chart will show that. You can see This is the chart of the average interest rate on the S&P 500 and Russell 2000 debt. The Russell 2000 is small cap stocks, S&P is large cap. And you can see that even though the Fed has cut rates now twice, interest on corporate debt is not going down with it. In fact, it's going up. And so that's where it starts getting concerning is the long end of the bond market pricing in, the Fed's cutting today, but over the next few years, it's going to have to come back and hike rates because the Fed cut too soon. And that's the concern we're watching. The first 50 basis point rate cut, the market had the opposite effect. Now they've done another 25. What will happen? Will this continue to push rates higher? Or will the market finally take the Fed at its word and start seeing rates coming down? But we're getting right on that concern level in terms of where Treasury yields are and where corporate interest rates are.
Yeah, and we're going to keep you updated on that. We're going to watch that closely and really appreciate that insight, Trey. And then I was challenged this morning by Ty Miller. Ty knows I like the phrase, history doesn't repeat itself, but it sure does rhyme. And next thing I know, he's using market data all the way back to 1928. Now, that's some historical data. So, Ty, I appreciate you going to all that trouble, and I thought it was very insightful. Talk about that.
Yeah, so focus on the S&P 500 index returns for 1 month, 3 months, 6 months, and a year later after an election. And so, as you mentioned, data goes back to 1928, as you can see in this chart. And so since 1928, I'll focus on the next year, a month, 3 months, 6 months, kind of a short time frame. But a year later, up about 7% on average and up about 58% of the time after an election. With that being said, though, if you just look at the last 10 elections, and that includes 2000 with George W. Bush, which, of course, 2001, we had 9/11, which of course made a big impact on stocks along with the 2000 crash. So factoring even that in there, average up, 15% after a year later, up 9 times out of 10, with the one exception being the 2001 time period. And so really the market, what it's, past data is telling you is that we just like a resolution, and we had that resolution. So after a year later, stocks don't have that uncertainty to deal with an election, and that's been good and telling, and we've had good performance since then. Now it doesn't have to continue that way every year. Every election's different, but just judging historically, we would expect a solid year in 2025.
Yeah. So there you have it. We're moving quickly through the rest of 2024. And as Ty said, in 2025, in less than 60 days, we're going to be there. And a lot's going on. And we're going to keep you informed. And just know that through our social media, YouTube, Facebook, Twitter, also on our podcast, we're going to keep you informed. Don't forget about us on LinkedIn. And just know that each and every day we're looking at this and navigating through it. But we think these are some positive things that you need to know about. On this Veterans Day, as we salute and honor those who serve this country, we are thinking about you and always appreciative each and every day. And in addition to that, every day here at Five Plan Partners, we're walking through the doors, striving to see to it that we make our clients' lives better, richer, fuller. We hope you have a great week, and we look forward to talking to you soon. Thanks.